This forecast, first of all, was put together about 2.5 weeks ago, and the world has changed just a little, bit, but I think the basic outline is still there, except the risks, instead of being in 2020, maybe next week instead of instead of in 2020. When we put the forecast together, we were, compared to consensus, we were a little bit low for 2019 and a lot low for 2020. I think the consensus is probably where we are now, or even lower than where we are now. The consensus has moved down a lot. And the reason why this goes early is we need a U.S. forecast in order to do a California forecast. A lot of the variables in the California model are driven by the U.S. forecast. So that sort of sets the stage. Our themes today are the GDP growth of 3.2% as originally reported, 3.1 as revised, was really in a way misleading. It was technically accurate, but it wasn't as strong as it looked. We still think we're on a 3-2-1 growth path, 3% in 2018, 2% this year, 1% in 2020. We have recession risk in late 2020. Ed's going to talk about that at length. Recession risk could be in the third quarter, depending on on tariffs, or even fourth quarter maybe. Employment growth is leveling off. This morning, the ADP did their monthly survey, which is a survey of counts about 20 million jobs, so it's much bigger than the BLS sample. And they're estimating only 27,000 jobs were created in May, and we've been running at a 220,000 run rate. Now, there's a wide variation between what the government's going to report on Friday and what ADP reported, but bonds rallied, interest rates went down on that ADP report today. And it's also consistent with what we've been talking about in the sense is that we're running out of labor, and the other issue is this real hemorrhage of employment in the retail sector when you read about stores closing every other day practically. The Fed, we had the Fed on hold through 1919, through 2020, and then and long rates staying very, very low. We had the Fed cutting in 2020. The Fed may cut on June 18th or 19th, depending on some of the numbers. That's when the FOMC meets next. Inflation, we think inflation is going to run modestly above 2%. I think there's several factors that were transitory that's suppressed inflation over the near term, and that will change. Trade wars remain extraordinarily significant risk. And it's interesting in noting that the Republicans are ready to override Trump on the Mexican tariffs, and I'll go into that in a bit. And we still don't understand why housing's not rebounding. We've had a 100 basis point drop in interest rates, and nothing's happened with housing activity, both existing home sales and new starts. All right, here's sort of the first quarter numbers. The original print was 3.2%. But if you dig down under the hood, inventories accounted for 6% of that 3.2, so we backed that out. There was a huge inventory build in the first quarter. That's not going to happen in the current quarter. Then we had a surprising increase in exports of 0.4%, so we backed that out. And we're sort of scratching our head as to where all those exports went. And then the exports are also going to be affected by the shutdown in the second quarter by the 737s not shipping because of the problems with the airplane. We had an import decrease of 0.6%, and normally imports tend to go up. So that's a one-off factor. And we had a surprising increase in state and local, so we have to back that out, and that had to do with all the road repairs associated with the storms in the southeast and the Midwest and the east, and that was sort of a one-off effect. So if you back out all these one-off things, the underlying rate for the core economy was 1.2%. So this 3% that everybody say, hey, yay, we're growing at 3%, is 1%. Now in the current quarter, we have a number of 1.6 as our current forecast. Some people a little bit lower than that, but the underlying strength will be over 2. In the second quarter is the headline will be, the real economy will really be doing a lot better than the headline. So it's a little bit inverse of what happened in the first quarter. Because when that 3.2% number printed, William called me up, David, we're all wrong. The economy's off to the races. And I said, nope, because we had all these one-off factors that are going to reverse. So most of them are going to reverse in the current quarter. And the other thing happening is there's a big dichotomy between what we call the household survey and the payroll survey for employment. Household survey is when the government goes to house and they ask, are you working or aren't you working? And that's where the unemployment rate comes from. The payroll survey comes from, they ask all these business firms, how many people did you have working in the second week of the month? Now, the thing is you could have 3 payroll jobs, but only 1 household job. Because in the household survey, are you working? Yes. You could have 1 job, you could have 8 jobs, you could be on 8 payrolls. So there's a difference in the way the surveys are calculated. Household sample is much smaller, so most people use the payroll survey. But you look over year, the payroll survey is 2.6 million jobs increased over the past year. The household survey was only 1.4 million. So there's a huge 1.2 million job delta between the two surveys. That tells us is that we think we're beginning to run out of people, and the household survey is going to be a leading indicator of the payroll survey. And that's sort of consistent with this ADP number today. Now, I don't know if it's going to be as bad as this 27,000, but by the 2 series, there's a huge difference. Ultimately, these surveys converge. So either the household survey's got to get stronger, or the payroll survey is going to have to get weaker for the numbers to converge. Because you see, at times in history they do converge. All right, here's our GDP forecast. We're at 1.6 for the current quarter, 1.8. We don't go over 2% this year. We go down to below 1% in 2020, and at the end of 2020, and when the economy gets that slow, that's when you have a real risk of tipping over into recession, because anything could happen that could just tip you over. Because if you view the GDP as the GDP number with a band plus or minus 2%, if you get down to 1%, it's very easy to go down to minus 1%. Very easy. When if the economy is growing at 3%, it's very likely you stay above 0. Okay, and here's our forecast for payroll employment, where basically growth is going to slow, flatten out in 2020, and then gradually increase in 2021. So the big jobs boom that we have, we think that is over. But I'm not going to rest my hat on the 1 ADP number. You need several months to see numbers running around 100,000 as opposed to running at around 200,000, which is where they've been. Unemployment bottoms where we are roughly now around 3.6, and we stay around 3.6% for the rest of the year into 2020, then gradually going up to 4%. Now, if we get a recession on that unemployment rate, which is 4, they'll go to 5.5. So that's why if there was a recession forecast here, that number would be going up much higher than to 4%. All right, here's where everything has changed. We had here, if you notice, we have the 10-year Treasury here around 2.5, 2.6. 10-year Treasury today, this morning, is 2.1. Okay, federal funds haven't changed yet. The 2-year note is down to about 1.8%. The market is pricing in a rate cut. We had 2 rate cuts in 2020. The market is pricing in 2 rate cuts this year, not in 2020. That's where the market is right now, 2 rate cuts this year. And as of this morning, after the ADP number came out, there's a 1/3 chance the market's pricing in that the Fed will cut on June 19th, when the FOMC meets. Their next meeting is a couple of weeks away. And it's going to be very interesting. I'd like to be a fly on the wall at that meeting. And so if you want to look at this forecast for the 10-year, you just move it down by 50 basis points, and that's probably what it's going to look like, as opposed to having it at these levels. So instead of peaking at 2.9 at the end of 2020, maybe it's 2.5. But that's also going to be depending on the whole inflation outlook as well. So that's sort of the big change. If I had to redo the forecast over, the Fed funds rate would be cut a lot sooner than what we have here. All right, inflation we have, this is headline versus core. We have it modestly going over 2%, headline versus core. The Fed uses the consumption deflator, which is a little different measure, which runs a little lower for inflation. That's still below 2%. But the thing is there was a technical change in the way the CPI was calculated, especially for Payroll. And the past few months, there's been huge drops, like 27% annual rate declines in apparel prices. And 2% in the month. And you sort of scratch your head. What happened is they changed their methodology in calculating the apparel prices. Instead of the BLS people going to stores and looking at prices, they get a computer printout from most of the apparel chains, and they use that as the methodology. And that was a break in the series, and all of a sudden it showed big drops in apparel prices, and we don't think that's sustainable. So that'll go both into core and into headline. That's the other thing about how the data is messed up. So we have GDP issues, we have price issues, and we have employment issues in what people are talking about. Okay. And we also have employment compensation, which has been running around 3% employee compensation. We think that's going to approach 4% by the end of this year. Because the labor market, if we're right about it, the labor market is tight, and we will see more wage increases, but not as much as we previously saw. Okay. Yeah. Well, if you're a true aficionado of Star Wars, the intergalactic war started over a trade dispute. Just remember that. If you really understand Star Wars, it started with all those 9 episodes had its origins in a trade dispute with the Trading Federation. If you look seriously at the screenplays, and this is our trade war with China. Especially with China, and now we have to deal with Mexico. And Mexico, the tariffs that the president proposed is a much bigger deal for the U.S. economy as Mexico than with China, because the supply chain relationships between the United States, Canada, and Mexico are probably the tightest international supply chains that exist in the world. A car will cross the border 4 or 5 times in the course of production, forgetting about where the final car gets shipped out of. And if the tariff is initially 5%, it could end up being 20% because it compounds 5, and every time it crosses the border, there's going to have to be a tariff. This has the potential, I call it throwing sand into the gears of commerce. It has the potential of really shutting down or really slowing down the automobile industry. And if you take a look where automobiles are made, and I sort of scratched my head why Trump is doing this, is the main automobile manufacturing centers in the United States are Michigan, Ohio, Indiana, Wisconsin, Kentucky, Tennessee, South Carolina, and Georgia, and South Carolina, Alabama. Every one of those states voted for him. I sort of scratched my head. I mean, this is basically telling all those auto workers in all those states there's going to be more layoffs coming, and this is coming at a time when there's global excess capacity in the automobile industry. So the Mexican tariffs could raise a car price $1,200, something immediately, right away. So we'll see if he puts them in next week. The other interesting thing is, for the first time, the Republicans are ready to vote with the Democrats to override them. This hasn't happened. We'll see if they do it or not. But this is the first time it looks like there's a unified Republican opposition to what Trump wants to do here, and it'll take a 2/3 vote in both houses to override those tariffs. So stay tuned for next week to see if he follows through on it. And it's very hard. We sort of scratch our heads. You can't run a long-term forecast, a short-term forecast, depending on some tweet that comes out of the White House. It is just very, very hard to do. And what's going on right now is the mirror image of Obama. Under the Obama administration, what happened was small businesses lived in fear every single day that there would be new regulation coming out of the EPA or coming out of OSHA, Occupational Safety and Health Administration, that's going to mess up their businesses. The regulations might have made sense and all that, but if you're sitting on the receiving end, you don't know what to do, so you slow down your capital spending, and the small businesses don't have lobbyists, lawyers, and what have you to go to Washington and to twerk the regulations in a way to make it easier for them. But now what's going on, the tariff issue, and in some ways maybe even the antitrust issue, what that's affecting is the big multinational companies. And so when they wake up, if you're sitting at General Motors or if you're sitting at Microsoft or if you're sitting at any one of these companies, you say, what's the tariff going to be next week? What's the antitrust law going to be next week? What that's going to do is going to slow investment. So you create a huge amount of uncertainty. You create a huge amount of uncertainty in the system, and when that happens, capital spending gets reduced, and it's beginning to show up in factory orders and big ticket items. So that's the impact of on-off tariffs. And the other thing is we don't know whether or not the United States is a reliable trading partner, because here we're ready to sign a deal with Mexico and Canada, and all of a sudden we potentially have a deal, all of a sudden throwing tariffs on everything coming in from Mexico. So if you want to make a recession, this is a good way. This is a very good way to start. All right. Here we have real net exports. We're assuming that some of this gets solved, so we have real net exports level off this year around 900 billion, and then goes to a trillion, then a trillion one, because we're still going to import lots of stuff. The federal deficit stays high. Now, you could argue, well, if we're going to get $200 billion, which is the tax increase from tariffs is equivalent to the Clinton tax increase in 1993. It's the biggest tax increase in 18 years. Who knew Republicans were interested in raising taxes? But I guess we found out. The budget deficit, in theory, well, if you have 200 more billion, you think the deficit would go down. But if it slows the economy, the deficit goes up. So it isn't clear whether there'll be any additional revenue coming from the tariffs if it slows down the economy. And this is where we sort of scratch our heads. Housing looks like it doubled from 600,000 to 1,200,000, 1,300,000, and it's gone nowhere. And we don't see any real meaningful recovery, even with the big drop in rates, until 2021. And then maybe we'll get a rebound. Now just remember, the normalized value for housing starts is 1,400,000 to 1,500,000. We haven't seen 1,400,000, 1,500,000. It's before the chart. You got to go back to 2007. Last time we had like 1,400,000 housing starts. That's what we normally have to do, and we're not even close right now. We're running around 1,200,000, and it looks like it's going to stay there. And there's a whole bunch of reasons for it, but it's also nationwide. There's only one city in the country, major metro area in the country, where single family. This is all multis and singles, where single family starts have returned to the pre-crisis highs. Anybody guess what that city is? No, it's not Los Angeles. What? Las Vegas, not Las Vegas. It's Austin, Texas. That's the one city where single-family starts have gotten back to the pre-crisis levels. No other city in the country on multifamilies happen in a lot of places, but not on singles. So to conclude is, the economy's slowing, 2% in 19. If we see these Mexican tariffs, it'll be less than 2%. Recession risk we have in late 20. Recession risk could be sooner. Employment growth is leveling off. The Fed, on hold, the Fed may go in 2 weeks, maybe, but probably by the end of the year, the market's pricing in 2 cuts. We still have a little bit more inflation than the Fed would like. The trade war is the big, huge risk, because it isn't only the tariffs blocking everything. It basically says, if you're a major multinational corporation, where do I put my CapEx? How do I rearrange all my supply chains? And it's one thing in the clothing business, the textile business, to move a textile factory from, say, China to Thailand or Bangladesh or something like that. It's a much bigger deal to move auto parts and auto assembly plants from one place to another. That's a huge deal, and it takes several years to build those factories. It isn't like building a textile factory. So it totally upsets all global supply chains. Trade war is the big risk, and housing, stay alive until 2021. Thank you.